Hello, this is Karen Spar, Executive Vice President of the Southport Oak Island Area Chamber of Commerce. And today we're talking with Doug Mieden of Carolina Business and Tax Advisors on how to optimize the value of your business. Doug, good afternoon.
Good afternoon.
Doug Mieden is the president of Carolina Business and Tax Advisors here in the Southport Oak Island area. He's been in business for 18 years here locally, and he also, prior to coming down to the Southport Oak Island area, he was also in this type of business for an additional 10 years. So Doug, I'm just going to get out of your way and let you talk about how to optimize the value of your business, because I know we all want to know how to do that.
Okay. Well, thank you for that introduction, Karen. And a little more background. I'm from the good state of Michigan. Went to Michigan State University, spent a little time in the Army in the 60s. And since 1994, I have been working exclusively with small business owners to assist them in achieving the goals of their businesses. And we opened here in Southport in 2004. The office was initially in Southport, where Renee's Jewelers is now located. And we're now in the St. James Square office buildings out on 211, across from the Brunswick Electric Company. So anyway, today we're going to talk about how to optimize the value of your business, and subtitled that whether you're ready to exit or not, because this is something you should be thinking about and planning for from the day you started your business. It's waiting until the exit time arrives is usually a big mistake and costly mistake. So what we're going to try to accomplish today, since this is a very complex subject, we'll go through the main factors that are involved so that you can understand what drives the value of your business, what the elements of value are, what your options are, how businesses are valued, and the goals. The idea is principally that if you understand all these things, you can work to the end of optimizing all those valuation factors so that your business will be worth as much as possible. So what are your options when the time to exit is approaching? You can retain ownership of the business. You just wouldn't participate on a day-to-day business, and you could draw income from business operations as a source of retirement income, or deriving the benefits of all the work you put in your business. A second option is liquidation. You basically sell everything that the business owns, shut the door, and walk away. You, as a third option, could transfer the business by gifting or selling to family. Another option is you could sell to employees. Employee stock ownership plans are used from time to time, although they tend to be very complex. You could sell to other businesses that are in a similar business or complementary business, or share a common customer base. Or last, and perhaps the best opportunity, is to sell the business to an investor. By that, I mean someone who's not going to be operating it on a day-to-day basis, but is looking to get a return on investment. Now, it's important that in your planning for exit that you decide which of these pathways is best for you, because leading up to the exit, you would do things quite differently from one option to the next. The best example of that is if you were going to sell to an investor, you would want the valuation of your business to be as high as possible to allow you to get the best price. If, on the other hand, you're going to transfer the gift to a family, or gift the business to family, you would want as low a valuation as possible. And that's to minimize tax implications. So again, how you set your business up, the steps you take can be quite different depending on which of these routes you pursue. Again, I can't overemphasize the need to planning for the exit and planning as early as possible for that, minimum of 2 years in advance of your date that you would like to exit, preferably more. Well, what are the elements of business value? There are two principal categories. There are the tangible assets, that's your furniture, your fixtures, your vehicles, real estate that may be owned by the business, patents, copyrights, any legal things that you own, your inventory, and your accounts receivable. All of these are tangible assets that can be sold. And if, for instance, you elect to liquidate, all these things could be sold. Not a good option though, because you typically get pennies on the dollar in a liquidation situation. The intangible assets are the products that your business or services that your business offers, the product knowledge of the business, how to do things, your customer list and your customer base and your reputation, any firm written orders or contracts. You may be doing business with a large company or the government and have a contract that is tangible or intangible, but has great value. And the management team you've built for your organization is an intangible, but very strong asset. And last but not least, and the most important element of determining a business's value is its ability to provide positive cash flow in the future. As in my experience, looking at business valuations, typically the intangible assets allow for or are about 80% of the total value. It's not just the tangible assets. So we know these elements now. How do you end up getting a valuation of a business? Well, the main method beyond the assets, the liquidation value, is to look on that future cash flow. It has to be an objective view. It can't be pie in the sky. And in engaging with a buyer, you typically would disclose your cash flow plans and forecast and the method to value the business and justify that cash flow based on the factors that were employed to create the plan or future cash flow and future P&L. The projections typically start with 2 or more years of actual results, and those are usually taken off of tax returns. The reason for that is, again, a typical investor would put more credence on a tax return, something you filed with the government, than on just a pro forma or a current result that has not been audited or reviewed in any way. So what do we do now? We've got this projection, and how do we convert that to a present value? Well, in a moment, I'll show you a few examples, but to get the idea of present value, it's a means to look at future cash flow and talk about the value of that in today's dollars. So it's like interest. If you put money in the bank at 10% interest, in 10 years, that bank account would, if you put 1,000 in today, that bank account would have $2,594. And discounted net cash flow is kind of the reverse of that. We do our projection, we look at the future revenue and bring it back to today's value. To get an idea of the importance of the discount factor is if it's 20%, that same $1,000 will be worth $13,000 in 10 years, or 30%, I should say, and $6,000 in 10 years at 20%. So why is that important? Because the discount factor chosen by an investor is a combination of their return on investment goals as well as the risk associated with the business. If it was totally risk-free, then the lower factors would apply. You would probably use a 10% factor. However, if it's a risky situation, the product's unproven, the management's unproven, the systems are not in place, an investor would use 30% or more to value the business. And that basically would significantly diminish the net present value or the value of the business. So it's risk, market conditions, and that factor is very important. Sometimes the comparable sales are used to determine a value for the business, but that's rarely done because they just aren't available. Most small businesses are privately held, and the sale information is not from public knowledge. So to get a little idea, let's look at how the present value works. And this is a very simplified income statement of a business that we've projected out for 5 years. And this is a business that makes $100,000 a year of income. It has cost of goods sold of $50,000, thus a gross profit of $50,000. We have expenses, overhead, rent, that sort of thing, of $25,000, which then leaves an income of $25,000. Now I've added a line on here for owner compensation because so many small businesses go down to that income line and say, my business is profitable, it made $25,000, but they didn't pay themselves anything. So that owner compensation represents what the owner would have earned or what you would have to pay to have someone else do what you're doing within the business. So in this case, if the owner were working 20 or 30 hours a week and would have the equivalent compensation of at least $25,000, then the net income of the business, what the business is making, is zero. So as you can see, if we have zero income, then we have zero present value. So the intangible future income potential of this business in today's dollars is worth nothing. You really have nothing to sell in this scenario, and you'd be looking at a liquidation or turning it over to the kids, but I don't know why they'd want it, but to assume the business. Let's look at example B. Now we've got an owner who is growing the business a bit and grows from 100,000 in the first year up to 5 years out. He's got the business up to $140,000. And to go all the way down to the bottom line, the net income goes from break even in year 1, but 5,000 in year 2, 10,000 in year 3, 15 and 20, and 4 and 5. And I've added a terminal value, and all that is an arbitrary figure to determine, okay, after 5 years, we exit the business and sell it. So that's what the 40,000 represents. So if you go down below that, you see the present value of that cash flow is $56,000 if we employ a 10% discount. But it's only $26,000 if we employ a 30% discount. And that, just to come back to why we were mentioning that the discount factor implies risk. And that's why it's important that the business be in order, that the business has the systems it needs, it has the management team it needs, and it is as risk-free as possible to a new owner. Therefore, the lower discount factor would be employed in determining the value of the business. If we look at example C here, this is where the business has gone to town. We've increased it from 100,000 over 5 years. We've doubled it to 500,000. The cost of goods sold has, or gross profit has improved. Everything is the same as the first two examples, except the business is more successful and is reporting more profit. Its terminal value will be far greater because the business is much more successful at the end or the time of exit. If we look again at these 10% discount factor, it's $154,000 for this business. So the value of the business is significantly different if it's more profitable. The value of the business is significantly different if a lower discount factor is employed. Again, if this business is set up well and runs well, then it would attract a selling price of more than double if we could argue for a 10% discount as opposed to a 30% discount. So key factors again, income, and that's growing the income, showing more profit. If keeping in mind that these projections are usually based on 2 years of income, and while most small business owners are conditioned to minimizing income so you don't have to pay taxes, when you come into the last 2 years prior to exit, that strategy is not a good one if you want to maximize the sale value of your business at exit. So 2 years going in, maximize your income on your income tax returns. Yeah, you're going to have to pay some taxes, but the multiples you'll get back in a higher selling price more than compensate for that, far more. So number one, maximize profit 2 years going in. And the other issue is to get your business in order and make sure that it can operate without you and that it represents a very low risk to a potential buyer. I like to approach this using what is called a franchise model. I didn't invent that. There's a book by Michael Gerber called The E-Myth. I encourage you, all small business owners, to read. But he advocates to set your business up as if you were going to franchise it. Whether you're going to or not, set it up that way. And by that we mean have systems in place so that your staff and employees are executing systems, not having to find a way to do something every time a different thing arises. So you want systems in place, you want management in place, you want your supply chain in place. And that serves the need of giving consistency to your business. It makes it easier to train employees and to retain employees. Now, my example of that is McDonald's. And as a franchise operation, it's, I think, known to be among the very, very best. And McDonald's has systems for everything. From the products that are used, to the way they're prepared, to the way the store is laid out, to the location of the store, to signage, to advertising, to what is offered in the store. That's why these systems are in place, and that allows a relatively inexperienced manager to run that multi-million-dollar franchise, because they're executing systems. They're not finding new ways to do everything. And that's consistency is also critical to grow businesses, because you have to have the same product, a consistent product offering. And that's why, again, with McDonald's, a Big Mac in Southport is the same as a Big Mac in Michigan and anywhere else for that matter. And that in itself gives great value to the franchise. I use my example not to be critical of anyone, but there is a local burger shop on the way to the Chamber of Commerce on Long Beach Road. It's a fine establishment. Actually, their hamburgers are probably better than McDonald's. But which of those two businesses would command the greater selling price? And I don't think there's any question that the McDonald's franchise is millions of dollars. So it's not inexpensive to obtain that. But why does it command such a high price? Well, you're buying systems with McDonald's, and you're also buying a very low probability of failure. Not too many McDonald's get in trouble. Okay. So that's important. The beauty of the franchise model, above and beyond making a saleable business, the issue is it also allows you to go on vacation and have time off without worrying that the business is going to fail without your presence. It's critical that the business be able to run without you, the owner, there every day, touching everything and making every decision. And that element is simply on that last statement of you go to sell the business and it can't run without the owner being there every minute of every day. Who wants to buy a job? They tend to sell for very low valuations. So what should we be looking at? Well, again, think about exit strategy. Think about what route you would intend to take, and work to optimize the business value from day one. And allow at least 2 years to prepare for that exit. And those last 2 years, again, remember, you don't want to minimize taxes. You want to show as much profit as possible. Yeah, again, it will result in higher taxes to the IRS, but that's the basis for your valuation of the business. I strongly recommend pursuing the franchise model, because if you have a good systematized business, then that will be much more attractive to potential owners. The beauty of it is that an investor could buy it and not have to be involved in the business other than oversight to obtain a desired return on investment. If the buyer has to be intimately involved in the day-to-day business, then again, you're selling a job and the value of that business is much lower. Again, improve that profit and cash flow on tax returns. And I can't underemphasize the idea of building a strong and capable management team for the business. Again, just think along the lines of the business should be able to run by itself. Think that you could go on vacation for a month and not have to shut the business down or be overly concerned about its viability. So that kind of concludes the presentation, the goal was, of course, to understand what drives business valuations, understand your options as you approach an exit, and last but certainly not least, to plan for this. Don't wait until the time arrives, plan for your exit and take the steps necessary to put you in the optimal position, regardless of which way you want to actually exit the business. So, and this is my contact information. If I'd love to talk to you, everyone who sees this, and any initial meeting is no fee involved. I just like learning about the businesses and the activities in the area. So feel free to contact me.
Thank you very much, Doug. That was very interesting. I love how you say, who wants to buy a job? I think that goes to the core of when you're going to sell your business. You want to sell a business that's running and has all your processes like you're talking about.
Absolutely. The difference in the monies you will derive is huge.
And in fact, I think that's a good way to look at running your business on a day-to-day basis, and not even just for the sale purposes, is to try to make sure that you're not creating your own job, you're creating a business that could run without you.
Mm-hmm. Yeah, that's why the franchise model or the systems within the business are so important. And that'll
And we're not picking on anybody's hamburgers. We love them all.
No, they alternatives to McDonald's hamburgers are really good.
Yes, there you go. They're both very good, but the processes is where you're going with that.
Exactly.
They have all their systems in place. Even though the one may have some system, it's not the same system as like a franchise. Correct.
Exactly.
Where somebody can step in and just take it on.
Exactly.
Doug, you talked about 2 years. Is there any reason that somebody might come in and say, you know what, I want more than 2 years?
They may, but typically not. I mean, the whole goal of an investor or someone buying the business is the forward look, not the backward look. That's there as to serve as a basis, to move forward with. It's really that projection. And in dealing with a buyer, what you're selling is, I'm projecting what's going to happen in the business. So I'm assuming sales are going to grow 3% and costs are going to grow 2%. And my profit margins are going to improve 1%. And you have to sell those factors, because if the buyer agrees with all the factors that you're using in the model, then he has to agree with the model.
Now, when we're talking about processes, small business versus franchise or a franchise model, not necessarily you don't have to go buy a franchise.
Oh no!
But where does a small business start to get those processes in place?
Well, it may be logged in the business owner's head today, and what we have to do is extract that and get it in a form that it can be standardized. And so many people think, well, that means a big book, and I'm just not up to writing a process or a procedure on, how to install a brick. What several of my clients have done quite successfully is, well, here's how you install a brick, and they have someone installing the brick and they video it with their cell phone. And that video becomes the procedure. It shows how to install bricks. So everybody in the business is going to install bricks in the same manner. And that's important to the success of the business. And if you think about it, just about any process within the company can be documented in that manner, which makes it a lot less painful than the thought of sitting down and writing a procedure manual.
I like that idea. That's a good way to do it. Well, Doug, again, thank you very much for sharing your expertise today with anyone that may be interested in how to value or how to optimize the value of your business, because that's what ultimately you want to do, is to make sure that those values are there so the risk is lower when you go to sell it.
Absolutely, because most small business owners have worked real hard to start that business and grow it and get it to the point where it is, and you want to cash in, if you want to say it. It's when the exit occurs and all good things come to an end, but you don't want to shortchange yourself and all your efforts.
Well, thank you very much again, and I hope everyone has a wonderful day. And if you have any idea for other seminar topics that you would like to see us tackle, please let us know.